To the Passive Income Podcast. This is the December 2023 live stream. Joining me today, Nelson, Bob, Mark, and Boomer. Welcome, guys. Let's go around the table and give yourselves some introductions. Let's just start with you, Nelson.
Okay, thanks, Dave, and thanks for having me on. I currently live in Edmonton after a kind of 20-year career, mostly in the retail business. I retired last year on my dividends, and that's it. I mostly just kind of golf and hang out and read and do stuff like this. So anyway, happy to be here and excited excited to talk to everyone about dividends, one of my favorite topics.
Nice, yeah. Over to you, Bob.
About Bob, I'm Taucan on my website. It stands for Taiwanese Canadian. In Metro Vancouver, been blogging for coming up to 10 years now. So yeah, and working toward our way toward financial independence by living off dividends. Getting pretty close, but no real plan in terms of when we'll pull the trigger, or just kind of take it as we go kind of thing.
And Mark, just quickly about yourself as well.
Yeah, so Mark Seed, blogger, owner of my own advisor. I've got a couple years on Bob. I've been doing this for like 15, so it's a bit of a labor of love, to say the least, but I'm sure some of us can attest to that for folks that have had blogs and write about financial journeys for years. Live in Ottawa, been here quite a few years now. Thinking about some form of semi-retirement, but I'd like to brand it more financial independence, work on own terms. So looking at doing that next year at some point. Enjoy seeing some of the income delivered from the portfolio. I know you're pretty passionate about it, Dave, but I do have a bias for growth too, because I just like things going up in value. So yeah, happy to talk about anything we want to, real estate, investing, or anything else you guys want to talk about.
Awesome. Actually, the first time that I've seen your name. Is that pronouncing it correct?
That's correct, yes. I'm in Vancouver as well, and I guess I'm the oldest guy here, but probably the newest one to all this, to the Twitter thing. I just created an account this year, and maybe in the spring I created an account, and I was following some different dividend accounts, so I named my account Boomer Divvies as a dividend account, but I don't chase dividends. It's just a small part of my financial setup. We're in the kind of development business and lumber business, and that's my main focus. And investing has just been kind of a sideline, but it's been obviously a great thing to have, because being in the market long term, and I'm older, being in the market long term is an almost guaranteed way to make money over time.
Right. So awesome introductions, everyone. I'm in Ontario as well. So basically, as you can surmise, we're all Canadian and investors, have a long-term mindset or approach. And yeah, before we started recording, we were talking about the different values of real estate. Here in Ontario, Mark in Ottawa, Nelson in Alberta, and then Bob and Boomer in BC. So maybe let's just jump into some of the real estate values. We were talking about property tax as well. So maybe let's just kind of jump back into a little bit of the same conversation we were having before we started recording.
Yeah, well,
I'll take it.
So I'm of course in Edmonton, as Dave kind of talked about there. And one of the things that I really, really like about Alberta, and one of the reasons why I'm from Alberta and I was born here, but I stay here because, the value in large cities. And Calgary, maybe not as much anymore. Calgary's been a great market for the last kind of few years, but compared to Toronto, Vancouver, Montreal, Ottawa, Edmonton is such a great value in terms of kind of the amenities you get for the price. I was saying, $400,000 in Edmonton gets you a house in a good neighborhood, and $600,000 gets you a really nice house in a new neighborhood. And I just love that value, and it just makes it a whole lot easier to get ahead when your mortgage payment is, $1,500 a month or $2,000 a month versus $4,000 or $6,000 or whatever. People have to pay in these larger, more expensive centers.
And then obviously your property tax is also reasonable.
It's about $3,500 a year.
Yeah.
So
Let's jump over to Bob.
Not bad.
You said Metro Vancouver, I believe, further south, like closer to the U.S. border. So, what are you seeing in? Obviously, we know the price of real estate in most of BC is expensive. So, I guess just sort of your area compared to maybe Boomer's area, Vancouver proper.
Well,
Yeah,
right
take it from there,
now,
Bob.
I'm kind of in an older neighborhood where there's some houses for sale. Basically, you have to bulldozer it down and build a new house, right? So we're kind of seeing a bit of that going. Yeah, right now, like that kind of places are going for over $1 million. So that gives you an idea. So you buy a piece of land for over $1 million, and these are probably about in my area about 800K. Sorry, 8,000 square feet lots. Yeah, so you buy a piece of land for $1 million, and you have to put up a house for I don't know, another 500K, 700K or something like that, right? So all these like housing investors, as you call them, they're doing that, and then you end up with new houses over $2 million in the market, right? A coworker of mine just built his own house, and he said he bought the land. This was in a different area in Metro Vancouver. He bought the land for about 1.3. Yeah, and then he built a house. So, and he said we just had a lunch the other day, and he said there's like 2 houses down his lot. It's like going for 1.2 again. Yeah, to bulldozer the house down, right? So that's what it's like. But yeah, I mean there are advantages living in Vancouver or Metro Vancouver. We obviously the weather is a little bit nicer. It's not as cold. We just need to get used to the rain, right? But yeah, and it's there's obviously various reasons why people like BC or Metro Vancouver versus rest of Canada, right? And even if you move into what's happening, and I'm sure Boomer could relate to this, a lot of people are moving from like Vancouver proper eastward, and that's driving
Yeah, out towards Surrey, Langley.
Even
all the way
like
up to Abbotsford and
Chilliwack and further out east, right? So that's driving the housing price up, and then even on Vancouver Island as well, it's driving the price up quite a bit.
Right.
Yeah, east of Vancouver, it went crazy during COVID, a little bit like what happened in the suburbs of Toronto, where everybody wanted to get out of the city because they all thought they were going to work from home for the rest of their lives. So these extended suburbs, they exploded. The prices exploded, and I think that like in the outside of Toronto, like in areas like Hamilton and places like that, or outside of Vancouver and places like Abbotsford, or as Bob mentioned, Chilliwack, they went up by 50 to 100% during COVID, but they've come back. There's been a pullback in those areas, and there's been a bit of a reality check, but still prices are way up since COVID. And like we're building single family homes in Seashell, which is on the Sunshine Coast, the half-hour ferry ride from West Vancouver, and then half-hour drive. So it's a city of 10,000. And when we started building there about 10 years ago, our goal was for the houses to be about 450 grand. And by the time we got the first houses ready for sale, we were selling more like 650 versus 450. And these are small houses. These are 1,500 square foot houses, but all with a beautiful view. And the houses now are $1 million that they're going for. And this is in some small town that's takes you an hour to get to from Vancouver, from West Vancouver. So maybe an hour and a half to downtown. And these houses are $1 million now. And it's, you know, it's expensive. It's kind of crazy. Like where I live is completely insane. But yeah, even around the suburbs of Vancouver is very expensive. Edmonton is one of the only reasonable big cities in all of Canada, or maybe the only.
Right. Yeah. And then Mark, let's you and I can take up Ontario. So and we'll contrast because you're in Ottawa, which is obviously one of those bigger cities, and then I'm in a very rural area. So it's going to be interesting to hear the difference.
Yeah, I mean, before we came online, we were talking about property taxes. Like, it's not uncommon for City of Ottawa property taxes to be, you know, in the range, depending on the size of the house and obviously where you live, but it's not uncommon to have that around, you know, $6,000-7,000 per year if you're in the city. So I did some quick searching here just as we were talking, and I think home prices have kind of stabilized a little bit here in Ottawa. I mean, I'm looking at the average sale price for November 2023 in Ottawa, and you're looking at, you know, 630. Single families higher, you're looking at 750, and then obviously townhouses will offset that and it'll be a little bit lower. But certainly it's not uncommon in my immediate area to have single family homes well over $1 million. If you're anywhere near the canal, you're probably 3 million, maybe higher, depending on your proximity to the canal and obviously the footprint you have in terms of a lot. But I mean, I just don't know where this ends, to be honest, because, you know, looking at various sites, like you look at a purchase price of $1 million, you need, you know, to avoid the high ratio, you need 200,000 down. Your required income based on, you know, debt service ratios and the like, you're looking at about 160,000. So, you know, for someone that has a $800,000, $900,000 mortgage, you know, beyond air quote the Ottawa property taxes, you got to heat the home, you may want to put water through your house, so on and so forth. You're looking at monthly expenses of about $6,000. That's after tax, of course. So the math doesn't add up very well. And again, Boomer alluded to it, Vancouver is a bit off the charts, and Toronto's not that far behind. So I don't know I don't know what the end game is, but housing is a crisis, depending on how severe you want to look at that.
I mean, having said that, I mean, Canada is obviously there's a bit of variety as you hear here, but like compared to some other countries, it's not near as crazy, right? Like, you know, I was just over in Asia, Taiwan and Hong Kong, for example, back in October for work, and you know, Hong Kong is nuts, right? Like, I was meeting a public company CEO, and he's like, I can't afford a house here, and he has a house. He was showing us he bought a place in Japan for $3 million. Like he bought the land and built it, and he was like, yeah, this is cheap, right? 3 million Canadian, and he's driving like a Tesla S, right? He's a CEO of the company. He's like very well off. Yeah, he can't afford a place in Hong Kong, right? And even in Taiwan, I was talking to my coworkers and stuff, like, and then walking around in just Taipei, seeing these like apartment flyers. They're like apartments for over $1 million Canadian, and the workers in Taiwan, like the average salary, it's a lot lower than Canada. Like, you know, like a fresh university. A student fresh out of university gets about 2,000 Canadian a month. So you got a lot of these people like can't even afford a place, right, in their lives. So
yeah,
it's not just Canada. It's crazy.
But those are very specific giant world-class cities. Vancouver is not. I mean, Toronto you can maybe say is, but I mean, Taipei's probably got 10 million people, and Tokyo's got 25 million people, and Hong Kong's probably got 10 or 15 million people, and they're gigantic world financial centers. And it's like living in New York or London. I mean, they're going to be expensive. Vancouver, there's no excuse. There really isn't.
Well, the mountains and the ocean is what makes Vancouver expensive.
I mean, I think Vancouver is a world-class city, and boomers kind of selling this city short, to be honest. That's what I think.
Yeah, agreed there.
I mean, it might be world-class in its beauty and stuff, but it doesn't have the things that if you go to New York or go to London or go to Paris or go to Tokyo, we were there this summer. I mean, it's nothing compared to those places. It really isn't. It's tiny. Tokyo's got 28 million people, I think, something like that. Or 38 million, something close to the population of Canada,
right,
in the extended Tokyo area. I mean, those cities are different. I mean, they're different, and there's not a gigantic number of them, but there's 20 or 30 of them. But Vancouver, I don't think compares to those cities. It's an incredible city to live in. I can't ever see myself moving away from here.
Yeah,
But,
I think part of the issue, and sorry I'm jumping in here, is that this whole American dream, right? Like you see new houses, and I don't know about the rest of where you're from, is like we're seeing houses getting bigger and bigger, right? Like 3,000, 4,000 square foot houses, or 5,000, right? Whereas in like, you know, Tokyo, Taiwan, these are more apartment buildings. These are more densified. Obviously, prices are high for various reasons, but you know, and we're seeing that a little bit in Vancouver, where although it's pretty extreme, we're seeing like, you know, $2 million houses getting ripped down and building townhouses, selling for way more. So Vancouver is trying to densify, but yeah, it's going to take some time to get there, right?
I think that's an interesting
I'm going to jump
concept.
in here.
I was just going to say, I think it's an interesting concept because everybody has kind of different needs and or wants. I mean, if you have a growing family, you know, living in a 2-bed, 2-bath condo in downtown Ottawa probably isn't going to cut it. That said, I mean, some folks do want, it's not a need, but some folks do want larger homes, right? Whether it's a growing family or they've done well as business folks or savvy investors or what have you. So that's all fine and good. I worry about the end game, right? I worry what's, you know, Boomer's correct in that Vancouver in our lifetimes is never going to be nearly as populous as Hong Kong or Tokyo or any of these kind of massive mega cities. But we don't want to necessarily have similar challenges or problems with housing, healthcare, or other types of, you know, kind of social issues, right? So I'm just very cognizant that, you know, for any generation, you know, kind of this whole balance of needs and wants, I think it's personal, but I think it's worth some reflection because it accentuates, it exacerbates the issue, I think, a little bit over time, right? If everyone wants, to Bob's point, wants a certain dreamlike home and wants a $3,000 or $4,000 square foot property, we're going to have some issues. We're going to have some haves and have-nots, and I don't think that's necessarily a good place for our country to be in.
Yeah, and
I'm going to jump in here.
Yeah, go ahead.
Sorry, Bob. I just want to jump in and provide a whole lot of, I guess, perspective and contrast, because I live in a rural area. I'm near the Bay of Quinte in Ontario. So, and I have a half-acre lot, maybe slightly bigger than a half-acre. My house is technically called a 4-bed, 1-bath. The 2 rooms upstairs are just basically little. It's like a 1.5 story. So it's not really bedrooms, but and when I bought this house 2 years ago, just over 2 years ago, it was one of the least expensive houses in the area, and I got it for $409. My property taxes just went down this year, so I believe they're under $2,000 for the year. So basically, there are affordable places to live in Canada if you're willing to live outside of the big cities and in areas. And also I have a decent job. Like, I'm not making hundreds of thousands of dollars a year, but I have a job that supports my lifestyle, right? So basically, I'm happy enough.
Yeah.
Sorry, Bob, I cut you off. What were you going to say?
Yeah, go
No,
ahead.
I mean my wife's from Denmark, so we go back there quite often, and even in Copenhagen, I guess that's kind of similar environment as Vancouver. Apartments are easily going for close to $1 million, or these are like old apartments, right, from like the 60s or even earlier. Now, talking to my in-laws, they're saying new apartments are going for like 2 million and stuff, right? And further out in Copenhagen where you get houses, yeah, those are easily over $1 million or 2 million. So it's similar, maybe not the Vancouver extreme, but then you move outside the Copenhagen, like in the countryside, similar to what Dave was saying, would be way more affordable, right? Like 400K, 500K, or even less with big land. So I think we're not seeing this just in Canada. I think it's a global trend, to some point, right?
Right.
Yeah, I was just going to say it comes down to land constraints is what it comes down to.
Mm-hmm.
The reason Edmonton is affordable is because when you look at Edmonton on a map, it can expand out forever in any direction. North, and like it ends up hitting suburbs like eventually, but the suburbs can just keep expanding out in any direction it wants. And when you look at kind of affordable cities in the US, they're either in the Midwest or they're in the South, and they can do the same thing. And ultimately, from an investment perspective, it's go long real estate in land constrained cities.
Yeah, and that's where
Yeah, that's
Vancouver
totally
is very
true. That's totally
restricted by the
true.
water and the mountains.
Vancouver is, and Seattle is, and San Francisco is, and they are very
And New
pricey
York.
as well.
Yeah.
I was just going to say that. Yeah.
Yeah, even you look at Silicon Valley now, you have like all the way from San Francisco down to San Jose. It used to be like little towns, but now it's just one giant town. You're just hitting all these different towns, right? And they're all getting extremely expensive. So again, I think the land constraint is definitely a reason for higher prices, right?
Okay, we could definitely talk about real estate for hours on end, especially real estate all through Canada because of the size of the country and the variations. Like we didn't even get into talking about how cheap you can get places in like northern Saskatchewan and remote parts of New Brunswick and places like that. But I do want to get to the chat as well. We have a comment here from Mark Hubbard, investor with 16,000 Patty, but also a big believer in Bitcoin, wondering if any of you have Bitcoin in your portfolio. If not, why not? Full disclosure, I have a small amount and I'm okay with it. I definitely don't want to have a big or large position in it, but yeah, anyone have Bitcoin, or what are your thoughts?
I have a little bit. My thoughts are I'm totally not a fan of it. I just bought it because I thought I could make money on it. I bought it in September when it was lower, and it's gone up like 50 or 60%. But it's a complete bullshit item as far as I'm concerned. I'm a very tech guy. I was a computer guy I had a computer in the 70s. I had an original Apple, and so I've always been following. I've known about Bitcoin for ages, and I've always thought, like, why the hell would people use this? It's so inefficient. Like it handles. No one uses it for a currency. I mean, they pretend it's this new currency. No one uses it for a currency other than criminals. And
criminals also use dollars, though. That's when everybody says, correct. "Oh, criminals are the only ones that use crypto." Well, criminals also use dollar bills, right? So
right, but so does everybody else for everything you do. Whereas everybody else is not going to Shoppers Drug Mart and buying shampoo with Bitcoin, or going to a restaurant, or doing anything. No one in Canada is using Bitcoin to buy anything ever. They're just using it. People are buying it as a speculative asset, which is what I bought it for.
That's where I come from.
I thought I could make some money on it. And so if I make some money on it, I'm sad I missed out before. So whatever, I bought some. But I still think it's a piece of crap.
Yeah, I don't get the utility yet, to your point, Boomer. Like what's the utility unless you're using this day to day, week to week, month to month, and it has comparable utility to everybody else that's using it? I don't get it. I don't own any. Probably will never own any. I have no idea. I have better things to do with my time than watch Bitcoin go up and down and people speculate on it.
Yeah,
Bob
we,
Nelson.
The transaction costs are very high. It costs within the Bitcoin network to actually have transactions written into the Bitcoin ledger costs a lot, and it's very slow. It's not like when you buy something with your Visa card. Visa's processing, what are they probably thousands and thousands of transactions per second. Bitcoin is not, and it's not capable of it. So it can never. People think it's going to replace this, and all banks should use Bitcoin, and it can't handle it. There's no chance it can handle it. And there's also 20,000 other shit coins that people have just invented. I mean, I posted a post the other day. I'm just going to write little piece of paper with money and call it Boomer Coin, and people can all buy it. But like somebody just invented.
And then you're just gonna rug pull it.
Coin.
I'm gonna write a white paper. I'm gonna put it out there. I'm gonna make 10 grand, and then I'm just gonna rug pull on you. Is all.
I mean,
and it's going to be on a piece. It's literally going to be a piece of white paper where I've written Boomer Coin on it. And anyone who wants one, I'll sell them one. And it's, why is that? And the people who just invent these coins, they keep 10 million coins for themselves. And then other people start buying them. These people are obviously dumping them as fast as possible to turn it into real money, which it's not.
Right.
So,
Bob Nelson, anything to add?
yeah, we don't have any Bitcoins for the same reason. We see that as speculative, and I keep thinking about this South Park episode where pump and dump, right? It's basically what people are doing, even NFT. I think right now is very speculative, and there are some ETFs out there you could buy, and even some ETFs that apparently provide some sort of yield, Bitcoins and whatever cryptocurrency. It's all very complicated stuff, and I don't know. There are countries adopting Bitcoins, but yeah, I think there's just too many slow. The transaction takes time, and there's all these complications. I don't see it getting there, and all these exchanges, getting caught and going bankrupt. That's another concern, right? It's like you have a place holding these currency that you don't know what the heck they're doing, and they're doing some shady stuff, and then next thing you know, they're gone, right? I have a friend. He started investing in crypto 5 or 6 years ago. He only put 10,000 or something. But he got into that exchange that I think it's Canadian, and he somehow mysteriously died in India.
Oh, that guy, yeah, who's apparently dead.
Yeah, and he lost with his money, and he was like, "This is stupid. I'm relying on the exchange. Can you imagine? We all own Dividend stocks, right? Can you imagine? Stocks is different, right? You technically own these shares, but can you imagine you invest your stocks through Chris Trade or Wealth Simple Trade, and then all of a sudden these online brokers go bankrupt and all your money's gone. That's unthinkable of, right? That wouldn't happen with stocks because those are registered to your name. But that's essentially what crypto is like, right? You're so heavily rely on these exchanges, which is pretty scary when you think about it.
Yeah, that guy was. He was the company was called Quadriga, I think, and he had the crypto in a cold wallet that only he had the password for, and then apparently he dies, so nobody can ever access it. And there's a third of Bitcoin wallets or something like that, 20% or a third of Bitcoin wallets have not been accessed for years. So if you own Bitcoin and you forget the password to your wallet, you can never access it again. The money just disappears. It just sits there like it's in a Swiss bank, and it's gone forever. So,
I'll say that for me it was very simple. There's two reasons why I don't have any Bitcoin or any crypto. One, I don't understand. It's outside of my circle of competence, and I don't care enough to understand. Two, it seems like all of these shadiest actors in the financial world just flock to crypto, and that's probably a bit of a red flag.
They were probably all in the VSE before.
You're showing your age, Boomer, the VSE.
Yeah, exactly.
Okay, awesome. Moving on from crypto, I know I'm jumping all over the place on the comments, but keep the comments coming. Thoughts on the FHSA, which I believe is a first-time home buying savings account, if I'm not mistaken. I imagine most of you have homes, so maybe under the radar. Seems like a no-brainer for any Canadian who hasn't bought a house. So
Yes,
yeah,
it's a
I believe
no-brainer if
we
you
all
have
do
a
own
house.
our own properties, but anybody that wants to jump in and comment on this comment.
It's like a TFSA, and it's like an RRSP, I think. And so, and I think if you don't end up buying a house, you can roll it into one of those other tax advantage accounts. So it is like my kids will get those set up. It makes sense.
So basically,
Yeah,
like the comment says, it's a no-brainer.
it's a no-brainer. You just need to figure out where you want to fund, right? Like, do you fund your TFSA or FHSA or RSP, right? And there's just you just need to model and figure out. Now, if you're just coming out of entering the workforce per se, then maybe you save an RSP room, right? Or you just need to figure out what's the most tax efficient way of investing your money, right?
Yeah, I'm the same. I think anybody that's striving to save for a home, if that's their goal, their first home, I should say, that first home savings account is the way to go. I actually have something on my website for my own advisor on that, just a bit of a primer, if you're interested. But essentially, it's taking a little bit of the best of the RSP and a little bit of the best from the tax-free savings account and kind of kludging those together a little bit. My only knock on this is, I really wish they just would have not created a boutique product and just changed the tax-free savings account contribution room, because I think it would have been a lot cleaner and simpler. We don't need a lot more tax complexity in our system. I think our tax system was already 3,000 pages long. I think that's plenty enough. But I get why the political winds do those types of things. But I would say for anybody aspiring for their first home, go ahead, learn about it, read about it, and take advantage of it. And that should be one of your primary accounts to start socking away some savings.
Nelson, anything to add, or we'll just move on to the next comment?
Yeah, nothing to add. You guys covered it well.
Yeah. Okay. So finally, we're going to get into some of a comment about stocks and stock investing. What's your largest stock holding? How much of a percentage of your portfolio? Why do you own it in 1 minute or less? And if you feel comfortable to share the dollar amount. I'll go first. It's RioCan. I probably have too much of it. Percentage-wise, I think it's around 20. It might even be 21%, which I know is very high. But over the last little while, with REIT being hit and it keeps going down, and I keep seeing it going, you know what? I can get another 5. So, and obviously that one too is I feel very comfortable with the dividend. They raised their dividend this past year. I think I don't know obviously, but I feel they may be raising it again next year. So, I'm okay with the amount of RioCan I have in my portfolio, but it is a little bit too big of a percentage. Yeah. So anyone who wants to either comment on that or just go next to the comment, floor is open.
Okay, I'll start. My largest is Smart Centers, which owns Walmart anchored retail real estate. They're also a developer who is developing kind of mixed use, all sorts of stuff in kind of the Vaughan area of Ontario. It's about 4% of my portfolio, give or take. I bought a lot of it in 2020, and then I bought a little more kind of this summer as REITs tanked. When in 2020, I was like I mentioned at the top, my career was in retail. I was working in grocery stores in 2020 when COVID happened, and I witnessed how busy these stores were firsthand because people panicked. They didn't really have anything else to do, so they would go to the grocery store. And I'm seeing one thing with my eyes, and then I'm seeing another thing in the market where Smart Centers is just destroyed because everyone assumes that no one's going to pay their rent anymore because of COVID. So I bought most of mine in the kind of $16 to $18 range, and it did quite well. And then it kind of sort of went back to, I think it's about 25 today. So I still like it. It's a little bit dicey on the debt side if kind of rates keep going up, but of course they're sort of doing the opposite of that lately. And the dividend is a little bit high in terms of payout ratio, but I like the assets, and long term, I think that it can sustain the dividend.
I'm just going to quickly jump back in there. I like Smart Center as well. I don't own it because of RioCan, and I feel that they're two very similar REITs. And I'm kind of guessing you're probably the same. You have Smart Center, but if any, not a lot of RioCan or none.
I have a little bit of RioCan, but ultimately with Smart Centers, you're right, it's very similar. What I really liked about it is the Walmart anchored versus kind of the, sort of everything else that RioCan has. Because ultimately, I think that Walmart attracts kind of these secondary tenants into these developments, and that's where Smart Centers makes their profit.
Right. Bob, you want to go next?
It's just I'm trying to be as not call it secretive. I don't provide exactly percent or value just because my face is out there. In fact, a lot of my coworkers know about my blog. Like my boss and his boss actually know about it. So I'm always trying to stay somewhat ambiguous. So I'll answer that question. Basically, we own I'll give you our top 5, right? So Enbridge, TD, Apple, Royal Bank, and XAW, not in any order. They're about anywhere from 5 to 6% of our portfolio per se, right? So that gives you an idea. I mean, all these are very solid. We got into XAW because we wanted to be diversified globally. Got into Apple because we bought it a long time ago now. I wish I bought it when iPhone first came out. TD, Royal Bank, I mean, as solid as you can be with Canadian banks, and Enbridge, we all know that we continue to rely on crude and natural gas, and that's not going away anytime soon. And with the environmental concerns, it's getting harder and harder to build pipelines, right? So the existing infrastructure that Enbridge has is more valuable than ever, and you actually see a lot of these pipeline companies getting acquired by the bigger guys, right? Like Interpipeline got acquired by Brookfield, and various things. And interesting enough, you'll see that TC Energy Crow, they gobble up some natural gas company, and they're planning to split up the company into 2. And I think Enbridge is, I believe Enbridge is going down that line as well. So it's an interesting way to how the business is going. But yeah, I'm pretty comfortable with our portfolio now. If anything, it's we own maybe a few more holdings than we want, so we're working to trim it down a little bit. But that's always difficult because, first of all, some of these are pretty sizable holdings, and it's like, well, if I sell, then which one do we buy next, right? So that's always a funny thing to do.
And you didn't want to buy Apple when the iPhone came out. You wanted to buy Apple back when Boomer bought that first computer in 1970 something.
Well, I wasn't born then, but funny you mentioned Apple. But I actually had a coworker. He went over to Apple. This was like before iPhone came out, and then apparently there's a loophole in the Canadian tax system. He retired and basically didn't pay any taxes on his options because there's some weird rules with the Canadian tax system. So he worked for a few years at Apple and then made a bunch of money through stock options.
Interesting. Mark, let's throw this same comment over to you.
Yeah, Bob and I invest very similarly. Like he said, he's got more holdings than I do or we do. But I would say my biggest one, like top 5, are similar to Bob. But the largest, I think, I've had to check the exact percentage, but it's probably Royal Bank, and then TD, Fortis, a couple others would be really close. And again, I don't disclose how much we invest in and such, but I do provide a fairly decent level of transparency on my site for sure. Just given I do also have coworkers and lots of other people that follow my site, which is great. But yeah, I would say they're probably hovering around 4 to 5% of the portfolio value. But I try not to let things, like there's a concept in terms of letting your winners run, and I get all that. But I wouldn't want to be I wouldn't want to over rotate on just a handful of companies through just through concentration risk, right? I'm never going to be as smart as Warren Buffett, but he's got 50% in his Berkshire portfolio in Apple, so that's great. But we're not talking millions, we're talking billions of dollars here. So that's not my league and never will be. But yeah, I mean, beyond a couple of the stocks we own, we're definitely increasing our low cost ETF position, just because it's lazy. And again, you can find other things to do with your time other than reading annual reports and those types of things. So.
And finally, Boomer.
My one is I have a number of accounts, only one of which I run because I predate this whole online account, and so I have accounts with other brokers, and I don't particularly follow them that closely. I just get the statements and I follow the amount, and so I look at what it's worth. And I mentioned to Bob on a questionnaire, like I've never told my brokers what to buy ever. And so I have 3 different guys that handle 3 different accounts, and I've never told any of them to buy or to sell anything. And then when they call me saying, we want to do this, I always just say okay, because then ultimately the performance of that account is always their responsibility because they've made all the decisions. I've said yes. These guys are all good guys, and they're not asking me to buy ridiculous things. But if I'm telling them what to buy and what to sell, I'd be 5 or 10 years later, I wouldn't know who made these decisions. But I do own Apple at around $15, so from a long time ago. But I'd say my biggest holdings collectively would be the Canadian banks over all those accounts. But recently, like what I'm buying recently is TSX and S&P index funds. I'm trying to get more U.S. holdings, and I don't care about my yield. So my dividend yield, which is I have a lot of dividends, it can go down. I don't care. So I'm buying more just on the TSX. I'm not sure. I think XSP or ZSP is are the funds. I'm putting money into those more, and I'm trying to buy more and have more money invested in the U.S. because I'm still heavily Canadian. And so it runs the gamut from Canadian financials, the Canadian utilities, and Canadian energy are the bulk of my holdings. And nothing is a very large percentage.
Awesome. I'm just going to jump right into the next comment here. Having JPOW talking of interest rate cuts this past week, are any of you adding increasing REITs exposure in your dividend portfolio? I'm not sure if this person is American, but obviously here in Canada, just this past week, Bank of Canada hinted that they would not be either raising or cutting rates anytime soon. But I guess just to anyone want to take that about the REITs question within this comment?
I can go first quickly. I mean, I have very limited REITs just because I feel where we live is a REIT, right? I gotta live somewhere, right? So that's real estate. I don't have any plans on adding or increasing, to be honest. I'm more. I think there's value there for sure. They've been beaten up, and I know Nelson owns a bit, and you've alluded to owning a bit REIT exposure, Dave. But yeah, very very limited REIT exposure beyond the brick and mortar that I live in. No plans to add, and interest rates may go down. Who knows what they'll do in the Canadian context, to be honest. It's going to be interesting because, yes, we usually follow lockstep, but inflation's still lukewarm here. So I'm not sure if there's going to be a disconnect in 2024 with the U.S. Signaling cuts and us maybe holding pat. I'll be watching like everyone else, but that's out of my control. So it'll be interesting to see.
Yeah, interesting. I'll just jump back in there. Not just RioCan. I have way too many REITs in my portfolio, and this past year they've been really obviously hit hard with the interest rates, and I've suffered through more dividend cuts than I care to talk about. So I really won't be adding any more. If anything, I will be thinning down, and that isn't really because of the interest rates or the hikes or cuts. It's more to do with just I'm overexposed in that sector. So
I think that REITs are a great value right now, probably the cheapest sector in Canada. And I'm a little bit like Dave. I probably own too many. For me, what I'm kind of doing sort of going forward is there's kind of this small segment of the REIT market that is sort of consistently growing funds from operations, which for people listening who aren't familiar with REIT talk, that's sort of the equivalent of a REIT's earnings. And then adjusted funds from operation is essentially its free cash flow. So what I want is I want a REIT that consistently grows FFO and AFFO on a per share basis. And what a lot of REITs have kind of been doing is they expand, they buy more stuff, they issue shares to kind of do it, to partially pay for it. And the earnings on a per share basis just don't go up. And so over time, what I intend to do is dump some of those REITs from my portfolio and focus kind of more on the ones that are that have a demonstrated history of growing their earnings over time.
Yeah, for us, we used to own quite a bit of REITs. We actually been trimming the last few years, probably around time to trim. But we used to own the likes of H&R REIT, which is mostly office space, Dream Office and etc. And we closed those. I work in high tech. I've been working from home since March 2020, and there's no plan to go back to the office. So I see the office REITs kind of tough. It's tough to be in that space. Now we do own the likes of Smart Center REIT. I think that one is really, really good. Just having the grocery store anchored Walmart. We used to own RioCan. We got rid of it earlier this year, I think. I don't know. I was pretty sour with the way they cut their dividends during COVID, and the chairman or CEO came out saying, "Oh, we're not cutting the dividends," and then a few months later they cut it. So that I was sour about that. So plus their dividends haven't got back to the pre-COVID level, right? So I figure it's better to invest that money elsewhere. We still own some REITs. We own, what do we own? Smart Center REITs, Vici, which is an American REIT for they have like casino properties in Vegas. Like they own basically like 80 or 90% of the strip, which is absolutely insane. And then the last REIT we own is Granite REIT, which is the industrial, right? So if you think about it, we got all these like online retailers, and they need warehouses to store their stuff, right? So I quite like these industrial REITs. Now, will we be adding more REITs? TBD, we haven't really decided. Probably not. We may add a little bit more Vici just to, be more a little bit diversified. This whole rate thing, it's been ongoing for years and years, right? People are like, I remember 5-6 years ago when rates were going up, people were like, "Oh, REITs will crash and burn," and they lived through that storm, and now the rates are supposedly coming down. People are like, "Oh, it's time to jump into REITs." It's like, stop predicting the market, right? Like just I think timing the market is way more important than trying to time the market. And when you're trying to, this is kind of a little bit like timing the market, right? Like you're trying to predict what the interest rates would be, and then trying to figure out which segment or sector to invest your money. It's just, I don't know. I'm more the mindset of, you know, finding great companies and invest in them, and then just, if you like them, just continue buying, either call it dollar cost average or whatever, you know, write it out kind of thing, right? Like what Nelson was saying, make sure the AFFO and FFO are increasing, right? Make sure their payout ratio isn't going crazy, kind of thing. So the thing with REITs is you really need to read their financials, because you can't just go on the website and look at the P ratio and payout ratio. So it requires a little bit more research. But yeah, I think, is there a place for REITs in your portfolio? I think so. What the exposure should be, that's kind of individual. Depends on the person, right? So that's my my chat.
I'm just going to quickly respond to this comment, because
I like
it's
it.
very true. I did get into RioCan after the dividend cut. So if you sold when they cut their dividend, it's very possible that I bought your shares.
I was just going to.
Yeah, I mean, it totally depends on. I mean, that it's a very fair comment, right? Like if you bought RioCan during COVID when it was super low and they just cut their dividends, for you it's actually great, because they're actually raising their dividends and the share price has gone up. But for us that bought it before COVID, it's no different, right? It's kind of like, you know, it all depends on when you buy it, and your perspective is different, right? Kind of like AQN. If you bought it years ago, you're in the waters. But if you bought it when it was, I don't know, like
bought it when I did.
You're like,
you bought it when I did.
Yeah. Yeah. So just depends on when your entry point is.
One thing
Remember, do you have any thoughts on REITs?
So Bob mentioned industrial REITs. Like I don't own any office REITs. I own Smart Centers, and I own RioCan. But our main business is owning warehouses and stuff. So we're landlords, and that business has been incredible since COVID. We've been a huge beneficiary of COVID, and actually before COVID, a beneficiary of Amazon and that type of business model of everything being shipped to warehouses and then going from there. And there's a big shortage in the Lower Mainland. I'm not sure what it's like in Toronto and some other cities, but our rates. So we did a couple renewals this year, and our tenants, two different tenants, had over 70% increases in their rent this year. And so it's been a huge benefit to us. We're getting way more money than we were getting before, and I understand the rates are softening a bit, but the square foot rates that guys were paying $7 or $8 a square foot, and then when we first built these buildings, the recent ones, and then they were maybe paying 11 or 12 on the lease that was in place, and the renewals were over $20. So there's a shortage of industrial space, definitely in Vancouver area, maybe in other parts of Canada. So I would think those industrial REITs may do well, or should hopefully do well, if they're seeing what we're seeing. Whereas the office renewals coming up over the next number of years, big accounting firms and big law firms that are in downtowns are going to go from 6 and 7 and 8 floors down to 3 and 4 and 5 floors, because people are working from home, and they don't need as much space, and they're downsizing, and their staff are working from home. So when the big office centers in Toronto and in Vancouver and Montreal, when they're doing their renewals, they're going to be struggling, not just to keep their rates, but to keep their spaces full. So I think there's a big difference between those two segments of the economy, of the real estate economy.
Yeah, just office space wise, our company used to have 5 floors, and we're down to 2.
Yeah.
So that's one of the reasons I'm like watching my company, the way they're utilizing the office space. I'm like, that office space REITs is getting tough. That's why we got out.
Loving all the comments coming from the chat, so keep them coming. What are your thoughts on the all-new Horizons high dividend ETFs? I'll go first again. I just haven't looked into them enough. I don't know enough about them, and so that's basically my comment on that. But anyone else have any thoughts or know more about it than I do?
Not too much, but I think I'd have to double check the holdings of particular tickers and stuff. But you're going to find probably a heavy emphasis on financials and energy, right? So not unlike what we've seen in the last few years, I think, to get returns, certainly from the energy sector, right? So natural resources is probably there, and a few other companies. And they're all going to be, the top holdings are probably going to be staples that you know, right? So financial institutions, big energy companies, maybe the odd pipeline. Like I said, I'd have to fact check that. So my thoughts, I happen to own many of those companies directly. So yeah, whether you own it in an ETF and you want to avoid the individual stock risk through the ETF, or you want to take on some of the individual stock risk for potentially higher returns, that's a bit of the trade-off. But there's a lot of merit in owning, a fund where you don't have to do the selection yourself, right?
Yeah, so I'm just on the Horizon website. I like Mark. I haven't paid any attention to this. I'm just looking at the what's this ETF, BNKL, and some warning lights flashed off because it's like in the investment objective it says it seeks to replicate to the extent reasonably possible and net expenses 1.25 times the performance of an index equal weight, yada yada yada. So they're doing leveraging, right? So we'll use leverage in order to achieve its investment objective. Leverage will be created through the use of cash borrowing or as otherwise permitted under security legislation. So personally, I when there's something that's high yield, you got to watch out, right? So whether it's covered call ETF, the high super high yield split share corps, or even like these like TSLYs and like absolutely insane yields, like 50-60% yields, like you need to be careful, right? Like you can't arbitrarily create yields without taking on additional risk, right? So how the heck, like when look at split share corps, right? Like if they're holding 15 dividend stocks and the average dividends are, call it 4%. Yeah, this ETF is yielding 10%. Like there's something going on there, right? So you need to understand that, and even most of these are done through cover calls and complicated leveragings. So there's very high risk there, right? So just like Mark, I rather own the individual stocks myself than ourselves rather than rely on ETFs.
Yeah, I've nothing to add. Bob covered it nicely. Just be aware that there's some stuff going on behind the scenes.
Yeah, this comment is related to just what we're talking about, so I'm just going to throw it up there. Covered call ETFs, which sounds very similar. Anyone else, anything more to add? Okay, there's another comment I wanted to get to here about options. Are any of you selling options to collect premium on your dividend stocks? Do we have any options traders in the house? Not me.
No, I know another blogger, Liquid. He's also in Metro Vancouver. Had the pleasure to meet him. He's doing quite a bit of options, but he's been quiet lately. Maybe he got a newborn, so probably busy. But I see like ourselves, we are not doing options, just like the rest of the guys here. For us, we just feel like it just takes too much time. Right? We're all busy with our lives, and I don't need to spend more time speculating. Like when it comes to options, it becomes a bit more speculative than dividend investing or investing in general, right? So I just don't feel like that's a good way to do things, and it just takes too much time. Now, some people have done it. Like I see some people that I follow have used
Feel like that's
option trading
do
to
things and
to supplement their income, and maybe that works great for some people, but for us, it's just not worth our time.
I think you bring up a good point, Bob. Like, I think it's worth mentioning. I know I talked to Nelson about this over the years. I'm not sure how Boomer feels, but you know, the whole notion of investing in certain companies for the dividends, growth, et cetera, it can be rather passive. Like I have companies that I've bought and continue to buy over the years, like almost 15 years now. I just don't watch the prices. I don't do anything other than maybe buy a little bit more when I have the money to do so. So the notion that certain forms of, I'll say, stock investing have to be active, i.e. covered calls, it depends on who you are, but I think it's a bit of a myth, right? You can be as active as you want to be on some things, or you can be fairly passive. And I'm on the mindset that the more passive I am, the less mistakes I make, the less transactions I have, the more free time I have to do other things in my life. I don't know. You don't have to invest in companies or ETFs. You can and be very active with it, but I find tinkering with your portfolio and trying to optimize and get premiums and such, it's a bit of a fool's game. So I just wanted to add in that comment that there's nothing wrong with the strategy, but it could be an effort in futility over time.
Yeah, I was just going to say
very
that
difficult too if you're working a 9 to 5, right? You can't be spending all day watching the charts and trying to keep your eye on a trade or a swing trade or anything like that.
Well, for what value? Like the U.S. market has gone up, what, 20% this year? 20% is a phenomenal year. I'm not saying everybody here has everything in the U.S. stock market, but even if you've got a bit and you've been pretty lazy with your Canadian portfolio, to have to check kind of a benchmark XIU or something like that for Canadian stocks, but it's up fairly healthy this year. Like it's hard to beat 20% or 10% here and there. Like, my goodness, like how much is your time worth? So anyways, I just thought I'd add that for folks. Sorry, Nelson, go ahead.
No, I was just going to say
you're going to say something.
Ultimately, covered calls are a trade-off between income now and capital gains in the future. You know, and that's a trade-off that kind of people are willing to make is they'd rather have more income today than the potential for capital gains in the future. But that's a trade-off. And, you know, the old saying says there's no free lunch in finance. And it's times when covered calls work and there's times when covered calls don't work. And ultimately, I'm not comfortable with that trade-off. As Mark said, it's definitely a time thing too. And I probably spend more time than anyone here kind of following because I have the time. And, you know, one of my new favorite expressions is that I have all the time in the world, but I don't have time for that. And that's kind of how I feel about options.
Yeah, and just to add to Mark's comment, like we want to be as passive as we can, right? So typically when we open a position, we try to enroll in drip, right? So we try to drip as much as we can, and then, you know, once we get into companies like Royal Bank, TD, or even like Apple, I don't bother reading their quarterly report. I may, you know, if something pops up on the news feed, I might be like, oh, okay, they're doing great, or, you know, but it doesn't take a huge amount of time to monitor our portfolio, right? We certainly don't check our portfolio on a daily basis, and, you know, for the most part, leave it pretty passive and just let it compound over time, right? So again, the whole cover call just, from the sound of it, takes too much time, and I got better stuff to do than, you know,
Too much time and effort, right?
Yeah, speculate, right?
Which was a great segue, Bob, because I heard you mention having drips turned on in there. Do you all have your drip turned on, or do you ever take out your dividends? So I do manual dividend reinvesting as opposed to automatic, but all of my dividends are getting reinvested at this point. And that's mostly the reason I like doing it manually, is so I can take advantage of dollar cost averaging down on other positions. That's my whole logic there.
Yeah, so I do take out my dividends. That's what I kind of primarily use to to live on at this point. My strategy is I have about a 4% kind of portfolio yield. I take out 3%, I reinvest 1%, because that combined with kind of portfolio dividend growth is, I figure, gives me enough of a safety net to kind of weather a 2020-esque storm again. And even when I was reinvesting my dividends, I did not have a lot of drips turned on. I had one or two, but ultimately it was from a capital allocation perspective, I wanted to kind of get the dividends and then say, okay, what's the most attractive opportunity in the market, and kind of reallocate my dividends there, rather than just blindly kind of reallocating them into something that I might think is overvalued. So that's my strategy.
Yeah, I don't drip dividends, but I don't take any out. All my dividends just remain in the accounts, and whatever, when cash accumulates, I decide what to buy.
So similar to mine, you just reinvest them manually as opposed to an automatic drip.
Correct.
You just have a lot more of them than I do. That's all.
Yeah.
Yeah, I mean, I've gone back and forth over the years, but certainly one account that I always reinvest the dividends or distributions in is the TFSA, because I just see it as a massive long-term growth vehicle. And so the more that the money is compounding and being reinvested, the better. But I think everybody is a little bit different. Some people do their self-made dividends, like selling stuff. Some people get the dividends or distributions paid out in cash in your RSP or your RIF. Nelson's point is really well taken in that he's using a big part of his portfolio to live from. So that's where the money is coming from, and keeping the capital intact. But yeah, I think one account that a lot of folks should consider if they're not using it for their income, and many aren't, is doing reinvested dividends or distributions inside their TFSA and taking a total return kind of approach. Whatever you own, ETFs, stocks, GICs, or whatever it is.
Yeah, and obviously the TFSA has the tax advantage of being tax-free.
Yeah, the way we do it, as I referenced earlier, is we try to enroll in DRIP as much as we can. We did what Nelson and Boomer did before, and they to some extent like manually sort of allocated, and again takes a bit more time. We like to keep it simple and boring. But the way I see it is like, even if you say you enroll in DRIP in TD, and you get a share each quarter, and you may get a little bit more if the price tanks, right? And then if the price goes up and you can't drip, then you could take that money and reinvest it somewhere. So in a way, it's kind of helps you to invest your money when the stocks is down a little bit, right? So everybody has their ways of doing things, and I think as long as you continue to invest money, that's great.
Yeah, interesting. Awesome, guys. We've been here well over an hour already. I know you're only going to have half an hour to spend with us. Before we go, though, I do want to just talk about one of my most favorite things on Twitter, which is Boomer. When you take a picture of the cars at your private golf club, which I know which private golf club that is, there's not a lot of Toyotas or Hondas in that parking lot.
That's true, and I'm going there. I'm leaving in like 5 minutes to go there for a Christmas brunch. So,
Nice.
And there'll be a helicopter there today because Santa comes to the brunch on a helicopter. But no, there's not a lot of Toyotas there, and I don't think the people are making their own coffee either. But Vancouver has a pretty nice selection of cars on the road in general.
Yeah, definitely.
Like my office, I think I posted this.
I just really needed to make that point.
Yeah, right by my office, within a 2 or 3 minute walk of my office, is Ferrari, Lamborghini, Bentley, Rolls Royce, BMW, Tesla, Audi, Range Rover.
Yeah, all the high-end dealerships are
McLaren,
right there on Burrard
they're-
Street.
Yeah, they're all right there. They're, and they sell, and there's tons of them being sold. And so it's, there's a lot of nice cars on the road in Vancouver. There really is.
Awesome. So yes, if you are driving a paid off 2006 Toyota Corolla, then hats off to you, because that is helping you save money. But at the same time, I don't expect every single millionaire out there to be driving an old Toyota, because a lot of people who are financially well off are spending that money on some of those nice cars as well. So again, we've been here well over an hour, but I just kind of quickly go around. Anybody want to say anything to wrap it up? Nelson, Bob, Mark, Boomer, anybody?
Thanks. It was fun. It was fun talking with you guys.
I think just
Agreed.
yeah, agree with everybody, but just kind of what we talk about the car thing, right? It's like, once you have a pretty sizable net worth and portfolio, it's okay to spend a little bit, right? Like, you can't continue to live like a poor broken student. Like, you need to live a little bit, and we, all of us, we don't know how long we're here for, right? It's you don't want to regret on your deathbed. It's like, oh, I wish I spent $100 to do something, right? Or at the end of the day, create experiences, right? We definitely spent a little bit more this year on some vacations and creating experiences, right? And that's totally okay. It kind of reference to that a book called Die with Zero. You're not taking any money with you when you die, so you could pass it to your kids and your grandkids, but isn't it better to use that money when you're alive, or when you could provide bigger financial impact, right? So for example, if you're giving your kids some money, like $20K when they're in their early 20s, a lot more effective than $20K when they're in their 60s or 70s, right? So it's okay to spend a little bit. Obviously, don't go too crazy and just blow your money on everything like drugs and all that crazy stuff.
Or Dave beer.
Right.
Yeah,
exactly.
everybody knows I spend too much money on beer, but that's a whole other therapy session.
Just wanted to wish everybody happy holidays on the Twitter/X stuff, and yeah, thanks. Nice to chat for a little bit on these kind of subjects, and you can have us back in 2024.
Yeah, definitely. Definitely. So, yeah, with that said, let's wrap it up, guys. Thank you all so much for being here. To Mark's point, happy holidays, Merry Christmas, Happy Hanukkah, whatever you happen to celebrate. And all the best to everybody. All the best for your financial future in 2024 and beyond. And thank you all so much for being here and enjoying this episode of the Passive Income Podcast.
Yeah. Thanks, guys.
Thanks, guys.
Thank you.
Subscribe.